There's been a bit of a wedge between what the IEA are projecting to happen with oil demand, oil supply versus OPEC, who tend to be a lot more positive on the demand outlook. But maybe let's just turn to the here and now. It's interesting to see that Brent is actually now back to where we were pre-OPEC Plus announcements. And what do you make of all of these announcements and voluntary cuts and dialing back out of the OPEC Plus in the last week?
Good morning, Joumanna. The IEA report is worrying, obviously, but we don't think that it's going to impact the market. It's a long-term report. It's not an immediate report. It's pretty theoretical. We've seen a significant market reaction from an oil perspective when we had the decision of the OPEC Plus last week to eventually unwind the cuts. But from market's perspective and spread perspective, I don't think the IEA report will impact. Even the OPEC Plus report did not impact. We've seen a reaction on the equities market, but not on the fixed income market.
What do you think oil recovered throughout the course of last week? Is it just because OPEC Plus were coming out and saying, look, these unwinds of voluntary cuts may not actually happen after all?
Absolutely. I mean, the first reaction was like, oh my God, we're going to unwind, we're going to have excess supply. And the fiscal break-evens are significantly high. So if we have oil going out of the range, then it's going to impact. So OPEC Plus kind of retracing is what impacted the market.
I mean, clearly, fixed income markets in the region are happy with oil trading at around $80. Spreads are so tight here. So what is the appeal of getting involved at these levels?
From a spread perspective, I mean, spreads won't be impacted if oil moves tiny bit. We think that if oil goes out of the range and drops significantly, this is where spreads are going to widen. Just stepping in the fixed income in the GCC, I don't think there's any upside at this point. But at the same time, if you look throughout EM, there is no upside. There's the places where we can see value are very limited. In the GCC right now, I think the only interesting thing is once we start extending duration is doing it through the IG part of the GCC. But at this point, I don't see any upside in the GCC space.
You know, when you say extending duration, I mean, there are two things going on here. Obviously, the absolute level of yields is attractive to think about as an investor, but then you also want to think about the future funding needs. And we're about to speak to my colleague Matthew Martin, who's been covering from Riyadh just how much of an ask Saudi Arabia has in terms of funding needs over the next decade to finance all of these mega plans that they have, the spending plans. And I wonder from an investor's perspective, where do you think those funding needs are adequately priced in to Saudi duration?
We have been seeing. I mean, if you look at Saudi spreads, they're close to double the spreads of its peers similarly rated. This is mainly driven by the significant fiscal needs and the very positive, very big projects that Saudi is there to finance. The tiny bright side in all of that is that Saudi mentioned that it might revise those plans if need be. We've seen the level of issuance this year that has been very well absorbed. We're already at 17 billion with the Aramco IPO. We had forecasted 30 billion for this year funding needs, which have already been completed. But we think we wouldn't be surprised if Saudi comes back to the market closer to year end because, as you mentioned, the very high funding needs that are upcoming next year.
Yeah, well, as long as oil stays at around $80, and I guess it's less of a concern. Let me ask you about Turkey. It seems as though it's become a real favorite trade for the international community. Lots of people piling into the carry trade over there. Do you like Turkey? Do you have Turkish exposure?
Absolutely. After Turkey being the underweight in all EM portfolio, end of last year, the shift into orthodoxy was what made investors step into Turkey. We've seen all the right steps being taken. We think that the CBT will continue on the monetary tightening stance. We think that the fiscal will also follow. So yes, we do like Turkey. We do like Turkish bonds. We think supply is going to come from the sovereign side. So the technicals there are not great. We like the bank subs. Those resets are very low. We don't think any of those is going to be called. But now from an absolute yield, those are very interesting. We also like the local currency trade. Inflation did not peak yet, but we think that we're on the right track and we think that we're close for inflation peaking. So I think the local currency trade is what has the biggest upside at this point.
Yeah, I mean, the assumption here is that fiscal and monetary are going to work in conjunction. I thought it was interesting. The deputy central bank governor, I think, was in London this week, and she said there is a risk that the minimum wage hike, another minimum wage hike, could be introduced over the course of the summer. If something like that happens, how would investors take it, do you think?
We've seen that happen earlier this year. Yeah. Investors were cautious on that because we haven't seen a reaction, because usually you see the immediate reaction. I think it's going to very much depend on how they telegraph it, how it's perceived. If a minimum wage is done and there's a counter reaction to it in a way to keep the market stable and not have a loosening monetary policy, I don't think we're going to have a negative impact. The flip side of the argument, obviously, is shifting back to unorthodoxy, and this, I think, would be unraveling to the market, but that's not our base case.